The Bank of England is set to cut rates, but can they pick up the pace? An expected cut that will take the Bank of England's key interest rate to 4% this week will be relief for an economy in need of a lift. But overwhelming caution and a split among policymakers means that the cutting cycle is set to be one of the most drawn out in modern history. So is the end of the easing road in sight, or will the central bank's mantra of gradual and careful remain? James Smith is developed markets economist at ING. So James, let's start and look at the data since the Bank of England last met. UK unemployment rose to the highest rate in 4 years. Is the labour market in trouble?
Well, the labour market has cooled a lot this year. There's no doubt about that. Employment has fallen for 7 out of the last 8 months. The question, though, is whether the speed of decline is getting worse. And that's not really clear at the moment. We had some very worrisome jobs numbers a month or two ago that were subsequently revised up. So there's no smoking gun here at the moment from the jobs market, which is likely to push the Bank of England into faster rate cuts. But it's the major risk right now. Clearly, it's something they've got to watch.
Well, let's switch as well to inflation, and other data points have provided a mixed message. Could inflation be the one that pushes towards faster cuts?
Well, I think at the moment the problem is that headline inflation is well above 3%. It's closing closer to 4% than 3%. And that's a worry for some of the Bank of England hawks. They worry that if inflation goes much higher, it's much more likely to get embedded in the economy, in the psychology of consumers and businesses, and that would sort of make it a more persistent episode. Now, there's good reasons to think that won't be the case, but I think with inflation, headline inflation where it is, services inflation, that key metric for the Bank of England, has also proven stickier as well. So for the time being, they are still worried about the inflation backdrop.
Well, much of the focus for tomorrow's meeting will be on the vote split. Should we expect another three-way split like back in May when they last cut?
I think so, yes. And I mean, it's highly unusual. May was highly unusual to see that three-way vote split. There's clearly a big disagreement on the way forward. A lot of that is born out of the mixed signals coming from some of the economic data, the fact that we can't trust the unemployment rate data, for example, given these long-running reliability problems, isn't helping matters. So yeah, we're likely to get one or two members voting for both no change and a larger 50 basis point cut, breaking from that consensus of the sort of 25 basis point decision tomorrow.
Any hints on how quickly the BOE plans to run down its balance sheet will also be in watch. What are you expecting, James?
Yeah, so the bank makes a decision on this every 12 months. So that's due in September as to how far they're going to run down their gilt, their bond holdings over the next 12 months. So we may get some hints on how they're viewing quantitative tightening. What impact is it having on markets right now, particularly in the context of the sort of bigger sell-offs we've been seeing, or the sort of general weakness we've been seeing, particularly in longer dated gilts through this year, particularly when bond markets globally have been more stressed. Do they think quantitative tightening is exacerbating that? If that is the case, then we may well see a reduction in the pace of QT in September.
Markets are pricing in one more cut by the end of the year. Do you agree? And how low do you think the Bank of England will go?
Well, I think this once per quarter 25 basis point cut is cutting pace is fairly embedded now. I think we probably will get another rate cut in November from here, and then probably another couple next year. Markets aren't really pricing that. They're expecting another cut later this year, but not much more in 2026. So I think we probably end at sort of 325. So that would say another three interest rate cuts after this month.
So overall, James, it does seem to be a difficult task tomorrow to take a clean take on a more or less dovish BOE. How do you think the pound will react?
Yeah, I think the key question is, does the bank change its forward guidance? It's been talking about gradual and careful rate cuts. I don't think that now is the point for it to fundamentally reassess that view. So I think that limits the potential market reaction this time. As I say, at some point we could see more of a dovish repricing in UK rates, and at that point that may put a little bit of extra pressure on the pound, maybe later this year or into next year.
That was James Smith from ING. Don't forget, you can watch more videos on Reuters.com.